And now, dear guest, allow me to introduce our Vice Chairman, Credit Suisse Asset Management, Mr. Robert Parker, who is our distinguished keynote speaker of today's event. He will brief us about global market outlook and traps for the year 2010. Thank you.
Ladies and gentlemen, good evening. It's a pleasure to be here. Andy Bruder has said that I will brief you about our analysis on global markets, but I only have 10 minutes, so I start with, frankly, a very impossible task. But let me just summarize our research and how we think the global economy is developing and how that is relevant for you here in Egypt. We know that the recession in 2008 was the greatest recession since the 1930s. We also know that it was one of the shortest recessions. The global economy started its recovery in the middle of 2009. But as we now see global economic recovery, we're seeing a number of very divergent trends. And the major divergence is actually the difference between growth in the emerging market economies and growth in what we traditionally call the developed world. Europe, America, and Japan face a number of very significant problems. I would just highlight the $1.6 trillion US budget deficit in America. That needs to be dealt with. Tomorrow, in the UK, we have the budget. The UK budget deficit is close to 13% of GDP. As a percentage of the GDP, the UK budget deficit is worse than that of Greece. Greece has a BBB credit rating. The UK has a AAA credit rating. It would be interesting for somebody to explain to me why the UK, where I live, still has a AAA credit rating. So budget deficits, one big problem. Another big problem is the behavior of the consumer. The consumer who in America and certain European countries was very heavily overborrowed is now increasing his savings dramatically. In contrast, if we look at emerging markets, most emerging markets did not have the problems of the credit bubble. They did not have the problems in the banking system, which was really focused on the American economy and the European economy. Over the next 5 years, our forecast is that the emerging markets will have an annual average growth rate of 6.7%. The developed world will only have a growth rate of 1.1% per annum. So I think it is fair to say that we're actually at a very important change in the global economy. So the growth is going to be generated by the emerging markets, and I think it is fair to say that we are at a point where finally we are seeing a major transfer in economic power away from the traditional developed economies to the emerging economies. We also have divergence in inflation. Inflation in Europe, in Japan, in America, if we look at core inflation, there is really no uptrend in inflation. But obviously the emerging markets have to deal with an uptrend in inflation. In India, for example, inflation this year will be over 10%. Egypt traditionally has had to deal with what is a reasonably high level of inflation. That means that we're going to see a very different policy response between the emerging markets and the developed world over the next 1 to 2 years. And that policy response in the developed world is that interest rates are going to stay very low. If you ask what will the Federal Reserve do over the next year, the answer is actually very little. interest rates are going to stay historically very low and will be negative in real terms. A similar picture in Japan, a similar picture in Europe. In the emerging markets, because of this uptrend in inflation, emerging market central banks are already raising interest rates. India last week. China is in the process of tightening monetary policy. Brazil will probably raise interest rates in the near term. In Egypt, your high level of interest rates probably will stay for some period of time. And that means that the Western saver will probably be very attracted to your capital markets. He'll be attracted to the high level of interest rates. And that means that emerging market currencies are likely to remain strong relative to the dollar, the euro, and the yen. One of my colleagues earlier on asked me to comment this evening on the dollar versus the euro versus the yen. And it's quite difficult because historically you would say one currency is strong, one currency is weak. Today, when you look at, for example, dollar-euro, you are looking at one weak currency against another weak currency. Today, the markets are dominated by the very difficult news on the Greek economic situation. That may well change later in the year. Later in the year, the markets may be focusing on not the Greek budget deficit, but the much more substantial American budget deficit. And consequently, this strength in the dollar, which could well last for another month or two, could easily reverse in the second half of the year. What I would like to do now is just to focus on a number of longer-term investment themes that we are pursuing at Credit Suisse. Because yes, we take shorter-term trading positions, but in the investment management industry, the winners are the ones that get the long-term themes correct. Obviously, the first long-term theme is this transfer of economic growth to the emerging markets. Within that, we see a number of sectors which will be winners. And those sectors are firstly the infrastructure sector. That is a very important sector here in Egypt. And infrastructure breaks down into the energy sector, the transport sector, and please don't forget the service sector in infrastructure, notably education. The second longer-term theme is alternative energy. We are all becoming much more efficient in our use of energy, but with the oil price staying at $80 a barrel, which I think it will, the economics of alternative energy become much more powerful. And I think this could well be an interesting opportunity for Egypt to develop its solar and other alternative energy businesses. The third long-term theme is demographics, and the clear winners here are the life insurance sector,